Good afternoon, everyone. Thanks for joining us for this webinar with Dixon Mitchell this afternoon. My name is Vince Oltert, for those of you who I haven't met yet. COVID-19 has definitely created a whole new paradigm in our society, as we all see as we put on masks to enter stores, and also with the markets, and it creates a lot of uncertainty around things, as well as the political environment, which we're seeing right now. And so we thought it would be wise to provide an update for clients of Dixon Mitchell to hear what they have been doing since we last hung out with them in March, and just hear from them. So today we're fortunate to have Don Stewart, who will be our main presenter from Dixon Mitchell, and as well as Jeff Gruber is also here from Dixon Mitchell. And so before I turn things over to them, just a couple of housekeeping items to deal with. If you have any questions, there's a question and answer button on the Zoom toolbar, which is at the bottom of your screen for most of you. If you don't see it, just move your cursor and it should show up. Just feel free to send the question through, and then we'll address that at the end of the presentation that Don has. And at the end of the session as well, we'd love your feedback. What did you like? What could we do better? And all that fun stuff. So if you could send us some feedback at the end, we'd sure appreciate that. We always want to do better with these things. So with that being said, I'm going to pass it over to Don to walk us through his presentation today. Thanks, Don.
Great, thank you, Vince, and thanks to everyone for joining us on this presentation. You'll see that I've titled the presentation "Markets of Surge, Where to From Here." Because what we hear from clients a lot, and what strikes, I think, everyone, is that markets, stocks especially, have done extremely well, while we see difficulties all around us, ranging from local businesses to what's happening with governments and what have you. And so I thought I'd just try and go through and with a few slides answer that question, and then we'll talk a little bit about what we're doing in portfolios and field a few questions after that. So let me see. Oh, there we go. So we're not going to make any big forecasts. As I say here, history is driven by a series of surprising events, and forecasting assumes that things are predictable, which of course, as the last year has proved, it's not. The best thing we can do, and the best thing that Connect can do for you guys, is to create a balance so that we're not over levered to one event that we think is going to happen, and the portfolio can be cushioned a little bit against things that are usually unforeseen. So just to open it up with what's happening in the economy, some reasons that things might be going well. In the US, these are surveys for manufacturing and services, and you can see that they took huge plunges at the start of the year in the first quarter when COVID happened, and are now back in growth mode. Anything above 50 in these surveys says that those respective areas are growing. So back to really where things were before the pandemic in terms of growing and position of those areas of the economy. Up here in Canada, the equivalent is the Canadian Federation of Independent Business barometer, and as you can see, it's back to where it was pre-pandemic. So even though things are taking a while to get going, a lot of businesses feel more positive about their outlook. So that's obviously a bit encouraging. If we look at world trade, this compares world trade volumes back in the 2008 financial crisis with where we are now, and you can see that we've bounced back fairly sharply, still quite a bit down from where things were, but on a much stronger pace of recovery than we would have been back in 2008. And sort of a more dismal sign of recovery, this is a snapshot of 12 cities that went through lockdowns and then reopened, and this is sort of pollution levels in those cities. So unfortunately, most of those cities, if we measure by pollution, are kind of back to where they were. Certainly London, Rome, Paris, what have you, have recovered. So that's sort of a non-economic way of looking at it, and unfortunately the clean air respite that we had is sort of over in most of these places. But this chart basically tells us that none of that really matters. And so this graphic is plotting on the left-hand side, or on the left axis, the return in any given year for the stock market against, on the horizontal axis, how the economy is done, so the growth of the economy. And this is looking at 30 or 29 years from 1970 to 2019. And you can see that there's almost no correlation. So all those economic charts I just showed you probably don't mean that much, because really the market tends to do its own thing, and isn't terribly driven by the economy. And so we can worry about what we see all around us, and coffee stores closing, and worries about employment and what have you. But really, the market tends to march to its own drum, and certainly that's what's happened this year. So why would that be? This is a graphic that you'll see in your fourth quarter report, and we wanted to take a look at that because you know, we had a lot of clients saying, you know, geez, things are so bad in the economy, how can the market be doing well? And we said, well, let's break down the economy and take a look at its structure versus the market. So the S&P 500 is broken into 11 sectors. So here we have the top sectors in the S&P, and the U.S. economy, the Bureau of Economic Analysis, which is a department of the U.S. federal government, they break it down into sectors as well. And so these are the top 5 sectors that contribute to U.S. GDP. And so you can see that really there's only 2 groups that kind of match up, and that's wholesale and retail trade, which is pretty self-explanatory, and then 2 groups in the S&P which we've combined together, which are consumer discretionary and consumer staples. And so those are retailers, household products, things like that, in those groups. And you can see that those are really the only 2 sectors that match up. The rest of them, really there's no mirroring between the economy and the market. So the market is important, but it's really just a subset of the overall economy. And so it can go its own way, despite what the economy might be doing. So if we look at those 2, or that graphic a little bit closer, you can see on the previous slide, you saw that real estate was the second biggest sector in the economy, but it's the second smallest in the market. In fact, it's less than 3% of the index in the U.S. market. It's a very small amount of the Canadian market as well. Government activity was in the top 5. Obviously, that's not in the stock market. And manufacturing is in the top 5 as well, and that's not a top 5 sector in the S&P 500. By the way, by grabbing the top 5 in the S&P and the top 5 in the economy, we capture about 2/3 of the economy and about 80% of the S&P 500. So we're catching most of both components there. On the S&P side, you saw that technology, healthcare, communications, and financial services were very significant, but really less important in the overall economy. So the 2 are quite different. The other thing too is member size. So the S&P and certainly the Canadian index as well tends to contain large companies, whereas the economy is comprised of many of those, but also thousands of owner-operator and mom-and-pop shops, what have you, the type of businesses we encounter every day, which really aren't represented in the market at all. If we look at, for example, the 2 sectors I talked about earlier, consumer discretionary and consumer staples, they've got names like Walmart, Nike, Starbucks, McDonald's, and big upstart Amazon. So clearly those are big, huge, multi-billion-dollar companies. In fact, the smallest company in those 2 sectors is worth $4 billion and did $8 billion in sales last year. So really, we're looking at a small, sort of a big, small part of the economy. In other words, just the biggest, most efficient, well-run businesses. And unfortunately, the economy includes those, but you know, many other smaller ones as well. And so, you know, for that reason, that's, you know, part of the explanation as to why the 2 can move in or not in lockstep all the time. So setting that aside, our market's still being a bit irrational. So this is a look at a Goldman Sachs index that they keep, one for companies with strong balance sheets, so ones with low debt and lots of cash on the balance sheet, and then ones for weak balance sheets, of course, ones that have lots of leverage and may be financially less secure. And you can see that over the past year, the strong balance sheet companies, the more conservative ones, have done a lot better, and the weak balance sheet ones have lagged behind. So certainly that seems like a rational choice of investors, that in these difficult times, they'd be more inclined to own companies that are financially sound. Again, this is another graphic that we included in our fourth quarter report. And we basically said, okay, well, let's dig a bit deeper and break apart the returns in the S&P 500 to see if investors are just throwing money willy-nilly at the market and being completely indiscriminate, or if they're actually looking for winners in the marketplace. So we broke down the market into 6 subgroups. So companies that have grown their sales over the past year at different rates. So ones that have shrunk by more than 20%, ones that have shrunk by 10 to 20%, ones that have shrunk between 0 and 10%, and then ones that have grown between 0 and 10, 10 to 20, and 20, and more than 20% over the last year. And you can see the returns, which is the vertical axis. The companies that have shrunk have actually been very punished in the market, and the ones way over on the right have done very well. In fact, they've grown in price this year by about as much as their sales have grown. So really, we can talk about speculation and irrational markets and what have you, but in reality, the companies that have done well business-wise have actually been rewarded. So that gives us some comfort that we're not in some sort of casino type situation with the market where things are just getting out of hand. So if we look at the companies and the sectors that are thriving in this environment, obviously things that have to do with us working remotely, being connected without being in place in offices and what have you. And so cloud technology, semiconductors have done very well. Online retailing obviously has had a big surge. Streaming media, movie theaters are really going to struggle to try and stay open even after COVID. Home improvement's done extremely well. We own Lowe's in our foreign portfolio, and it's had a great year because people are spending more time at their homes, so they're spending more money on their homes. And of course, healthcare has done well as well. So these groups include companies with big index weights. The big technology companies, again, Home Depot, Lowe's, they're massive companies. The Johnson Johnsons, the Pfizers, some of the biotech companies are big weights in the index, and so they've been in the right area, but they've also had more influence on the index because they're big companies and they carry big weights there. The struggling sectors, energy has been really hard done by. Obviously, everyone knows hotels and airlines are struggling. Bricks and mortar retailers were already in rough shape, but this has really pushed them into a difficult spot. Restaurant operators, office malls, things like that. And you can probably think of other names as well. But in this group, these tend to be smaller, less significant companies in the index. And so they, even though they've been punished, and you saw on that chart, the companies that have had low earnings growth or earnings contraction have been really hurt. They tend not to be big weights in the index compared with the other companies. And so they've had less of a negative impact, even though if you own those stocks, you've done very poorly. So if we put that all together and we say, okay, that's great, but what about this bubble in technology? We keep hearing that we're seeing shades of 1999. People are just paying too much for technology, and it's all going to end badly. So for sure, some of the tech names have gotten ahead of themselves, and we want to be careful. I mean, recently we've trimmed some names out of our tech holding, or trimmed some weights out of our tech holdings, and put that cash elsewhere. But by and large, with technology, you get what you pay for. These are very profitable companies. If you look at that gold line, shows the cash flow margin, so the amount of cash flow they take out of earnings. You can see for technology companies, it's almost double what it is for the rest of the market. And so, that has to do with the fact that tech companies are generally very capital light. They don't have big factories and equipment and unionized labor force and depreciating assets, and so they can keep a lot of that cash without plowing it back into the business. And so, at the end of the day, yes, they've done very well, but they're also extremely profitable. So we want to make sure that we have some exposure to those areas that are doing very well and making a lot of money with their capital. This looks at a couple of lines here I'll try and explain. So the black line is the share of technology companies in the market. So out of the S&P, you can see at the peak of 2000, tech companies were about a third of the S&P, or 34% of the S&P. Now technology accounts for about 28% of the S&P. So still a very big weight in terms of index value. But the difference now is that their share of earnings is pretty equal. So back then, at the peak, technology had about a 16% share of earnings for the S&P. So they had a very high weight in the index, but only about half of that in terms of their share of earnings. And now their share of market weight and their share of earnings is fairly equal as well. You can see that earnings in 2000, I mean, basically fell apart, because I think, you know, technology was very early then, and in some ways those earnings were a bit of a mirage, whereas now technology is entrenched, it's driving the economy, it's a very big part of what we do. And so we don't feel that they're you know, possibly as fragile as what they were back then. And so yes, technology is a big weight in the market, it's had a huge run, but it's also accounting for the lion's share of the market's earnings as well. So of course it's risky being invested. You know, most of you probably have balanced portfolios, and the bonds help out in the volatility. But I don't think you want to be uninvested either. I think that could be riskier, or as risky going forward in terms of the opportunities that you're going to miss, and the lack of growth that your portfolio will have. So I just put this chart up as sort of an economics 101. So this is the history of the world in terms of economics. And you can see that if we look at global GDP per capita, from the beginning of time to about around 1700, not much happened. There wasn't really much growth in terms of economic output at all. You know, tools improved, and processes got a little bit better, but society in general never made any leap forward until the Industrial Revolution. And what happened then was we discovered, or in England, they came up with the factory process and the division of labor. And instead of one person making a product from start to end, we had specialization and assembly lines and what have you. And suddenly, the economic output per capita started to leap forward. And then we had the second industrial revolution, which was things like electricity, internal combustion engine, what have you. That sent the economic output ahead further. And now we're in the information age, which really began in 1975 and has been growing since then. And so the share of DuPont and heavy manufacturers and, you know, Eastman Kodak and Dow Chemical and, you know, whatever the name may be, their share of the economy has been shrinking relative to companies that deal in knowledge and information. And I think that's happening at an accelerated pace right now. So we could be in a situation where we're in this sort of third industrial revolution, where the growth of information and technology really takes a leap forward. And the reason I say that is because periods like COVID tend to spur innovation and future growth. And if you look at the 20th century, the fastest decade for productivity growth actually was the 1930s. And that's because companies and people had to be very productive, because it was a very difficult time. And so they had to make the most of whatever they had. And so now we look at what's been thrust upon us in very quick order. We've seen a leap in remote work and remote education, cinema, entertainment at home, grocery, meal delivery, telemedicine, e-commerce, robotics, artificial intelligence are all making leaps forward. Microsoft has come out through their Azure division with a product where I can give a presentation here in Vancouver in English, in my voice, and I'll appear in Tokyo on stage in a hologram with my voice speaking in Japanese to the audience. And you know, you think about things like that were experimental before, and now they're front and center in terms of being needed and being useful in the economy. And so when things like that happen, the workforce is becoming more digital, more flexible, more skills-based, more regional, and of course more productive. And so for all of the difficulty we see around us behind the scenes, it's spurring a lot of innovation, a lot of great things happening. And we want to make sure that we're a part of that, and that the portfolios are positioned and your assets are positioned to take advantage of that. So if we look around us, there's a term used by the economist Joseph Schumpeter in about 1950 called creative destruction. He said capitalism basically is in the business of creative destruction. So if you think about it, photography. So film photography was very popular in the 70s and 80s, and then digital came around and that wiped out film photography, and then phones got cameras and that wiped out the camera business essentially. And so we see this creative destruction happen where new businesses are spawned out of old ones, and they sort of regrowth all the time. And so if we look at it now, some of the things that are happening, you can see that this is the growth of e-commerce as a percentage of retail sales over the past decade or so. And you can see that it was growing at about a nice, 11-12% clip up until about 2019. And now, just in this last little period, we've grown by a third in terms of e-commerce volumes. And again, I would guess that it's probably not going to go backwards. If anything, that trend will continue. And so, there's a lot of reshuffling and implications for real estate and employment and all the rest of it. As well, if we look at talking about real estate, this is looking at a survey that Moody's does. They've done for the last 15 years or so, looking at businesses that are looking to add office space versus those that are looking to reduce office space. And you can see that that blue line adding to office space is now basically at 0. So it's never been that low, but there's nobody out there that wants to take more office space at the moment. Whereas the number of firms looking to reduce office space is at an all-time high. And so again, creates very difficult conditions for some sectors of the economy, but will create opportunities for others as well. And then this is just another snapshot looking at vehicle miles driven in this summer. And so that's for the second quarter. So middle of the summer, which is usually a big driving season, you can see that it's fallen all the way back down to where we were in 1995 in terms of miles driven. And this is supposed to be a year when people stayed at home and did more locally and probably spent more time in their car than in the airplane. But here we are, again, road traffic, at least in terms of distance traveled, has really declined. And so again, we may go back to where we were, but habits tend to stay. And so, we'll see how all of this plays into the shape of the world going forward. And these are all things that we need to think about in terms of positioning the portfolio and who's going to win and who's going to lose. So looking in the portfolio, we did a few trades, kind of trying to take advantage of some of these themes and making sure that we're well positioned. So in the first quarter, we switched out of, in the Canadian side of the portfolio, we switched out of Finning and moved that money back into Dollarama. We had owned Dollarama in the past when it was a much younger company, then sold it after it had a huge gain. But we felt very comfortable with where Dollarama was at the moment. And just trading out of Finning gets us out of a heavy industrial into a business, one of the few areas of retail that's doing very well, the discount retailer. And you can see that trade has worked out fairly well in portfolios. On the foreign side, again, we reduced or got rid of a fairly large historic industrial in 3M and moved that capital over to a stock that we had already owned, but just bought more of it in Roper Technologies. And Roper owns a suite of industrial software, high efficiency, increasing businesses. And again, that trade has worked out very well. They're really a cutting edge company and at the forefront of many of the technologies that I've been speaking about in this presentation. So again, just more fitting with where we see the world going. And so far that's worked out very well in the portfolio. So philosophy and practice, everyone coming up in the third quarter will probably have slightly different returns because you all have different asset mixes. But one way to look at a snapshot of how we've stacked up against the peers is through a fund that we sub-manage called the BPI Canadian Balance Fund. We've looked after it since it was formed just over 11 years ago. And you can see that it's had fairly solid returns overall periods to the end of September. But versus its peer group, and there's about 400 funds in this group across Canada in the Balance Fund group. Pardon me. That's just from speaking, not from COVID. You can see that it's exceeded its peer group by a fairly wide margin over that time, and it's beat its index over the whole period as well. It's been first quartile ranked over 1, 3, and 5 and 10-year periods. So again, just sort of putting theory to practice there. So luckily, I'm at my summary because I think I'm running out of wind. So I would just say that the world's in a difficult space right now. but we don't want to spend too much time navel gazing and looking at the difficulties now, because I think this is also spurring a great deal of innovation and potentially future growth. For us, we want to think about the traditional metrics in our portfolios, things like valuation, cash flow growth, but especially we want to think about what industries are going to benefit from this rapidly shifting backdrop, and make sure that we're positioning your assets to be in the right place. We want to own businesses where the world is coming their way, instead of where they're trying to chase where the world is going. And so for us, we'll just keep trying to balance those attributes. Not every decision will be perfect, but if we stick to a philosophy and are disciplined about it, then we'll have a good batting average in the portfolios and continue to perform well. So with me fading rapidly, I'll turn it back over to Vince to take over.
Don, thanks. Sure appreciate it. And your voice lasted just long enough, so that's spectacular. No, I appreciate that. That was some great information, and love seeing some of those comparisons that you saw there. And we've had more people recently bringing up the idea of should we buy gold or silver with the uncertainty in the world and things like that, or even some people. And you answered one of the things which clients have been asking, which is, should I just go to cash? But what about gold and silver in a portfolio? Is that a good idea, bad idea with all the uncertainty?
Yeah, I mean, I've personally never been a gold fan, because ultimately you're sort of just relying on price speculation. It ultimately is a speculative investment, because it produces no cash flow, no income. You're essentially holding this inert object, hoping that for whatever reason the price is going to go up, which is by definition speculation. The other problem I have with gold is that it tends to do nothing for a decade, and then it earns all of its returns in a very short period. We've been through one of those short periods now where over this past 3 to 6 months, people have gotten excited about gold again, and it's made a big leap up. But the danger is that if you look at the path of gold, it'll have these periods of gain, and then it'll go nowhere for a long time. And my worry would be that the world has sort of digested the idea of the government stimulus and the quote unquote money printing and the rest of it, and a lot of that is accounted for in the price of gold. And my worry would be that the buyer of gold here is at the end of the current run rather than the beginning. But I'm certainly no expert on it, but those are just sort of my observations about it.
No, that's great. Appreciate that. Now, the other one market that tends to be a price taker, which depending on your view, is energy, which Canada, our economy is quite reliant on historically. What's Dixon Mitchell's kind of view of energy? Is there time traditional energy done? Is that what you're thinking around that?
Well, I think there'll be some money to be made in energy, because the stocks in general have been creamed so badly. But when I said that we want to own companies where the world is coming our way, rather than be in situations where we're kind of trying to chase where the world is going, or when it's running away from us. You think about energy in that way. We've seen a big drop in energy demand, and it'll recover a bit, but we're probably not going back to the same levels that we had before. There's no way that air traffic is coming back, in the next few years. Maybe if ever, to the same levels. I look at myself, I was taking 3 business trips across the country previously. Now we're doing Zoom meetings, and I'm not sure if I'll go back to traveling like that. As well, working downtown, the offices are still probably more than 3/4 empty. And talking to KPMG in BC, they have 1,400 employees. So far, 100 have gone back to work. And they expect that probably only 200 to 300 are going to go back to the office. So if you think about that, that's 1,000 people that will not be driving or commuting to work anymore. They'll be getting up, making themselves a coffee, and working from their home office. And so, again, the long run demand situation for energy, I think, is limited as well. Every day you know, there's another electric car on the road. And so I just don't think the backdrop is great. Now, again, there's probably a trading profit to be made there simply because these things have been creamed so badly. They probably need to recover. But in terms of an investment case, it's tough to make one.
Mm-hmm. That's great. You know what? I think you must have answered a ton of questions, Don, because there aren't any more.
Okay.
So I just want to say a great big thanks to you and Jeff for making time to hang out with us today and just kind of give a synopsis of what you guys are seeing, where you're going, and that type of thing. Actually, one more question I'll ask is before we go is U.S. election. Do you expect or that to have an impact on portfolios, or is that something that is just kind of noise in the background?
Well, I think, you know, anything that you and I can contemplate right now about the election has been thought about through the market many times over. I think, you know, it looks like probably Biden's going to win. So two things. One, it probably means that stimulus flows a bit more easily, which would be positive for stocks, but it probably also means that the easy tax regime that Trump had put in starts to disappear, which would not be good. So you know, I don't think anything's going to happen instantaneously, but that'll be definitely something for us to watch, sort of weighing those two things.
Mm-hmm. That's great. Yeah. Again, thank you. Sure appreciate your time, Don and Jeff. I know you guys are busy guys, so thank you. And for those of you that are listening live or are listening to the recording that'll be posted online later, if you do have further questions, you can reach out to your advisor here at Connect Wealth, or you can reach out to Jeff directly at Dixon Mitchell, and he'd be more than willing to answer any questions you might have. So thanks, guys. Appreciate it. And we'll talk to everyone soon.
Thanks, everyone.